The Enterprise Investment Scheme, or EIS, is a way for the government to incentivise private investment in small and growing companies. You can invest in a single company or in a portfolio managed by a professional manager and receive very generous tax relief. So what do these small companies actually do? Virtually any trade qualifies, from a new restaurant chain to a company developing a cybersecurity software, and anything in between. The key requirement to qualify for EIS is that the company needs to be young, independent and entrepreneurial. So the qualifying rules have to do with the age and size of the company, but also with how ambitious its plans are. The key thing is the company must have objectives to grow and develop over the long term, and investors must take significant risk. However, that risk is somewhat tapered by the generous tax reliefs on offer. So what are these reliefs? There are 5 main ones. First, when you invest in an EIS company or portfolio, you can get income tax relief of up to 30%. Invest £10,000 for instance, and you could receive up to £3,000 back, assuming you've paid or are due to pay sufficient tax in the first place. Each tax year, you can invest up to £1 million into EIS, or £2 million if you invest in at least £1 million into innovative companies, classified as being knowledge intensive. This could net you up to £600,000 in income tax relief. Second, if you make a profit when selling your EIS shares, any capital gain is tax-free, providing the investment remains qualifying. Third, EIS also allows you to defer capital gains potentially indefinitely. So if you've made a capital gain in the last 3 years or up to 1 year after, for instance you've sold a business, liquidated a large share portfolio or sold an investment property, you could reinvest that gain into EIS. When you do that, you don't have to pay capital gains tax until you sell the EIS. The rate of capital gains you'll pay is the one prevailing at that time. If you've already paid CGT, that can be reclaimed too. Let's assume, for example, you have an income tax bill of £30,000 and a capital gain of £100,000 with a CGT bill of £20,000. That's a total liability of £50,000. If you invest £100,000 into an EIS, you could wipe out the £30,000 income tax bill. You could also defer your capital gain. This means rather than automatically handing over £50,000 to the taxman, that money is now working for you. You do need to keep the investment for a minimum of 3 years. And so when you exit, you either have to pay the CGT bill at whatever rate applies at the time, or you can invest it in another EIS and defer it again, assuming there are no changes in legislation. But what happens if the EIS doesn't work out? This brings us to the 4th relief, loss relief. Not only can tax relief boost investor returns if things go well, it can also soften the blow if things don't work out. Thanks to this loss relief, you can write off any losses either against your capital gains or your income tax bill. This means if everything went wrong for an EIS investor and they lost their whole investment, the actual loss to a 45% taxpayer could be effectively just 38.5 pence of every pound invested. The final EIS tax relief is inheritance tax exemption. Hold the EIS for at least 2 years and continue holding it until the point of death, and the value of the EIS should be IHT-free, potentially saving 40%. But just how risky are EIS investments? EIS are not for everyone. Small and unquoted companies are statistically more likely to fail than large ones. To keep the tax relief, you need to hold the EIS shares for at least 3 years, and they have to remain qualifying. EIS investments are also illiquid. You can't usually sell them in the way you would sell a quoted share. It's generally up to the fund manager to arrange an exit, for instance by selling the investee companies or helping them float. Also remember, the value of tax benefits depend on circumstances and tax rules can change. You should seek specific advice on the tax benefits if you're unsure. And of course, like all investments, EIS can fall as well as rise in value, so you could get back less than you invest. Your capital is at risk,